Hi, Steve Van Metre here. Welcome to your Monday night premiere. We take about 15 minutes every Monday and Wednesday night to try to make sense of markets that I actually think starting to make a lot of sense. Okay, so they're moving in the way I've thought they were for some time. And just so you know, we're waiving the 15-minute limit until further notice, and just because there's a lot to talk about. So Sunday afternoon, the Fed surprised everybody by cutting the federal funds rate to 0.25%. So the funds rate is not zero. For some reason, we do this weird split rate thing for now, but we'll assume that not in the not too distant future, it will be zero. And they decided to kick up their quantitative easing program, which I do not have full details on yet. I imagine we'll get that on Wednesday at their press release, which I would have said the other day would be the most watched Fed press release in history, but it might be a nothing burger now because we already know what they did. So they're going to increase their quantitative easing program that I believe we can now actually call quantitative easing to 700 to 800 billion, but over what period? Not sure. We do know that today they purchased approximately $40 billion of US Treasury and mortgage-backed securities all across the entire yield curve. So if you own bonds, the biggest buyer in the market is coming in right behind you, and that is pretty cool. So let's dive right into a Q&A section. I didn't actually realize this was going to be so popular, but I got a lot of comments about how people really like this, and I got some questions that came in over the weekend and today. So let's start out. The first question is, do you think the US Treasury will issue a 50 or 100-year bond? And the answer to that question is I do not think they will. And the reason is I don't believe there's a lot of demand for it. So the question is why do we even have 30-year bonds? Because we didn't have those. In the grand scheme of Treasury securities, they're new. Now, they've been around longer than I have, but they're still the new kid on the block. And why do we have 30-year Treasuries? Because we have 30-year mortgages. So if you're going to issue an asset, you have to want to find a matching liability. In that case, you have 30-year debt and a 30-year asset on both sides. So that would imply that perhaps we would see 50 or 100-year mortgages, which I think is a really terrible idea. Now, some of you are going to listen to that and say, man, Steve, that is smart. I agree with you. And other people are like, but that means my payment would go down. Look, let's cover this really fast. The car industry used to do 5-year loans and 3-year leasing. It's a great business model. People that didn't want to own for whatever reason, they would lease, and every 3 years the dealerships knew they had a potential buyer. And if you bought, after 3 years, you could roughly break even if you needed to trade in your car, and then anytime after that, you could trade it in with equity. There's the word I'm looking for. Then somebody had the great idea to say, people can't afford these overpriced cars, so let's go to 6, 7, and 8-year loans. And now what's happening is after the warranty is up, people are going in because their needs change or they put too many miles or whatever reason they want to trade their cars in, and they're upside down. So before anyone who's listening to this who's a realtor thinking, man, if I had a 50-year mortgage rate, I could cram people into some really big homes, just think. It would at first, but now go look what's happening in the car industry. They can't sell cars for the life of themselves because everyone's upside down. So yes, would there be a surge of people buying homes? Yes. Would there be a surge of people refining at a 50-year rate? Yes. And then you'd watch the whole real estate industry come to a grinding halt when people realize it was time to sell their home, they'd lose money. Should I short the bond market if they come out with that? Okay, I cannot give trading advice, and I will not. This is not a trading advice channel, so I won't. But I'll answer this question this way. If you believe shorting 30 years if they came out with a 50-year bond is a good idea, then are you short 10-year? Did you short 10 years when they came out with 30? It doesn't make a lot of sense to me because what you find is all yields follow each other. So if you've watched any of my videos where I've shown you the charts, or I recommend go and chart the federal funds rate against 5, 7, 10, 30, and 30-year yields and tell me, would you short? Probably I wouldn't. All right, is QE inflationary? Oh, I've been dying to answer this question since the Fed announced it because I asked that question to myself so I could share it with you. And I'm sure a lot of people want to know the answer. And the answer is no until it is. So what is QE? QE is where the Fed goes out and buys bonds. And for some reason, and let's put this into current terms. Everybody knows toilet paper sold out everywhere, right? So let's say that I went before everybody else and I stocked up and I got a pallet of the stuff in my garage and I want to sell it because I heard you might need some. Why would that mean the price would go down? Why would I sell that at a loss when there's no supply? Does that make sense to you? Doesn't make sense to me. It would seem logical that if I knew someone who was really desperate to get some, that I would sell it and make a profit. But yet when the Fed comes out and buys bonds, everyone assumes that bond prices somehow have to go down and interest rates go up. So why would I be willing to sell my bond for a lower value because the Fed's buying up all the inventory? Does that make any sense to you? It certainly doesn't make any sense to me. And the charts, of course, find that they agree with my view as well, because we can go back and look at historic trends of QE and Treasury yields. The other factor is, and I think this may help some people understand what QE is in actuality, is if you've ever had a mortgage and got a mortgage. Now, for those of you who haven't, when you get a mortgage, the mortgage rep oftentimes will sell you points. Now, if you know anything about points, and I worked in the mortgage industry, I was told long ago, don't ever buy points because you're making your mortgage broker rich. And sure enough, I worked in the company I worked for. You could see the top guy in terms of commission did half as many loans as the guy who didn't sell points. Go figure. So what is buying points? It means you're paying the mortgage company or the bank to give you a lower rate. So you pay it up front. It doesn't make a lot of sense because most people move every 7 years anyways, but that is what QE effectively is. There is a zero bound, as far as we know, on the federal funds rate. And so how does the Fed drive rates down? They have to buy bonds. And when they buy bonds, what happens to interest rates? They go up? No, they go down because interest rates and bond prices, as we all know, are inverted. So yes, QE causes bond prices to go up. Now, I talked about this before, but I think it's relevant to bring this back, is who has been buying bonds for the last 3 years? Well, the large commercial banks and the smart money. Now, do you think the large commercial banks want to sell at a loss? The Fed's their best customer, because when the Fed comes and say, hey man, we need to buy $40 billion worth of bonds this month or today, and we only buy from you, the banks, who get to bid on it. Do you think the banks are going to be like, oh man, Fed, we heard you're desperate, so we're gonna take a loss. This time we'll cut you a deal. No, they mark it up. And the Fed, why would the Fed care? They don't. The Fed's going, hey, we need to pump liquidity in the system. You're going to charge me a premium? Yeah, whatever. As long as you win the bid, you'll get the deal. QE is not inflationary until it is. It becomes inflationary when yields fall enough to drive lending demand. Now, with the entire world shutting down and going under quarantine and not allowed to do anything or touch anyone or look at each other, get even remotely close, do you think there's going to be a lot of people that want to run out and buy a home right now? Nope. Now, there's people that want to refi, but guess what? The banks don't have any money all of a sudden. Yeah, so what do we know? Low interest rate equal tight financial conditions. A lot of people want to refi, but they're not going to. My boy who sells Volkswagens, in case you're looking for one, he says people won't come to the dealership now because they're afraid. I'm not sure. Maybe people at the dealership have the virus. I don't know, but he says they won't even come. I told him, if you get something cool and I want to test drive, but said nothing. So anyways, that's the whole idea. People aren't out borrowing right now because they're sitting at home. The other thing is, when you look at all these people that are part-time hourly employees that are not going to be getting work from home because their job requires them, I don't know, maybe they're a masseuse and no one wants them touching them anymore. What's going to happen as all this money around the world that's circling and swirling around comes grinding to a halt, which it is right now? See, that's what's happening with world dollar liquidity. And let's go back to that because it's really, really important that we talk about this for those of you who did not fully grasp it. Dollars cycle all around the world. And there's only one solution, and I'm going to answer another question, is how fast do you think this is going to recover and how low do you think it's going to go? Let's revisit this because I want you to critically think about what is happening. So here's how dollars flow around the world. And think about this. Consumers buy foreign goods. Now, when we buy a foreign good, let's say I was going to go out and buy a German automobile. Everyone likes, or Japanese automobile. People like those too. Am I going to pay cash? Well, odds are I'm not. I'm going to borrow money. right? And that creates new money in the economy. Now, those dollars flow to foreign companies. Now, when they start seeing orders come in, guess what they're going to do? They're going to think demand's increasing. What are they going to do? They're going to go borrow more money. Why? Well, they need to build more cars, build more factories, invest in research and development. So again, money is being created, maybe not in dollars, but in local currency. Now, those dollars at foreign companies, when they get too many of them, they exchange them with their foreign central bank. Now, the foreign central bank doesn't do anything specifically with them other than pile them up. So once the foreign central bank, so there's no really inflationary expansion of dollars here, other than it is inflationary to that country. So let's say this was an Asian or Japanese central bank and they were building up dollars, it would create inflation in Japan. So to tamper inflation, they send those back to the U.S. by buying U.S. Treasury securities at an upcoming U.S. Treasury debt auction. So they buy U.S. Treasuries. When they get those Treasuries back, they're not that inflationary because they receive interest. And the fact, the less interest they receive, because interest rates are low, the less inflationary they are. Now the U.S. Treasuries got some money, and of course the U.S. government loves to deficit spend, so it borrows more than it has and spends it in the economy. So you get borrowing, and what happens here is this cycle of dollars expands. And this is very important to understand. It expands, okay? So what the Fed did is they tightened monetary policy, which destroys dollars, not physically, but it destroys the number of dollars in global economy, right? We talked about this on Friday. We had the tax cut, which in turn brought repatriated dollars from foreign banks, which are needed to grease global economy. So that reduced world dollar liquidity. We had a trade war, which reduced trade. And when you look at trade on that cycle, you go, well, I can see why trade reduces world dollar liquidity. We had high oil prices, and not that that was an issue, but it was an issue because shale became the biggest we became the biggest oil exporter due to shale production. And in terms of world dollar liquidity, what do we need to do? U.S. consumers need to buy foreign goods. Oil is one of them. We need to buy foreign produced oil. That is how the cycle works. And with this talk, and I don't know if it's official, but I heard President Trump say that he wants to fill up the strategic petroleum reserve, which is around 70 to 80 million, not billion. Yeah, sorry. Got a few people excited there. Million barrels of oil, take about 2 to 3 months. If we end up only buying U.S. produced oil, it will not help world dollar liquidity. We need to buy. I mean, I know somebody's thinking, why are you so pro buying foreign stuff? Only from a world dollar liquidity standpoint, my friends, only from when you understand how the global economy works. Now, what has going on now? Travel, trade, everything is no dollars are flowing. And then now domestically, as people are finding out that, hey, my income's going down, my job's, my employer's closing down, I'm going home, I'm an hourly employee. Think about this. A lot of schools are closing. Did you know there's a lot of families that one of the spouses is a full-time substitute teacher? I mean, that is their job. Maybe they don't sub every day, but guess what? They're not bringing in all of a sudden income. Yeah. So what happened and what is causing this whole problem is we killed for the world dollar liquidity cycle. Now, it's not completely dead, but we contracted it terribly. One thing after another was just killing the cycle of dollars, leaving the U.S. government as the only player left in the game. Because when they borrow, they mostly borrow they do borrow from foreign companies, from foreign entities, but they don't have a lot of dollars. So we have to borrow it out of the U.S. economy. So the only solution is massive amounts of quantitative easing, which I said would happen. And on Sunday afternoon, we found out it did. But here's the problem with that. How does massive amount of quantitative easing start the cycle? Let's go back. We have to have consumers are buying foreign goods. So how does that occur? You have to want to go out and borrow money and buy a foreign produced good or service. That's why interest rates are not coming up. They're going down, way down. Because until people go out and buy foreign produced goods and services, there's no number of quantitative easing. The Fed, they could do QE infinity squared to the cubed and make it infinity and invert the thing 30 times, and it will not create any growth until you and I and everyone else in America goes out and buys foreign produced goods. Until then, interest rates are going down. That's the cycle. That's what you need to understand. So where does this now go is what happens with the Fed rate cut? It leads to lower interest rates. Why? Because everything follows interest rates down. So since when interest rates go down, stock prices fall. This is a bear market. This is what happens in bear markets. They go down together. Your charts look like this right now. They go down together. So when you see yields falling, which we know because world dollar liquidity is at the worst it's probably ever been and getting worse by the day. Every week this thing persists. Everyone keeps saying, but Steve, the infection is not as bad as you think. Look, I'm not focused on that. From the world dollar liquidity standpoint, the engine is grinding to a halt. And the only way to restart it is to get people to go buy foreign produced goods. The Fed can't print money. It's against the law. So, okay, the next question is, will we have a V, U, W, L, or some other letter recovery? And what does all that mean? A V recovery means the economy comes down and bounce. Well, the other way around. A W means it looks like a W. A U means it's group and comes back up. An L means it comes down and goes flat. You have to understand, how many baby boomers were convinced to put all of their retirement wealth in stocks? Nearly all of them. And they're down, what, up 25+%? Now, do you think, how many of them are maybe grateful right now their cruise just got canceled or their European vacation? Because they're probably thinking, oh, how am I going to pay for all this stuff? I now have 25% less money. They're hoping the market comes back, but until it does, you're going to watch their spending go to the toilet. Seriously. Now, how's all this spending going to come back when people, hourly wage people, are not bringing in income or as much income? It's not. That's the problem. We have to kick the economy started to get people to go spend money. It's going to be very, very difficult. So where do I think this is headed? Well, my friend in Hong Kong and I have been debating this. I tend to agree with him. But let's look at the charts. I know we're going out of order. We'll get back to everything in a moment. Let's look at volume. Do you see okay, I see a lot of trading volume. No, you don't see a lot of trading volume here. You want to see a lot of trading volume? Boom. This is called capitulation right in here. This is when you've had enough and you say, I'm selling. And I thought, I heard so many people over the years say, oh, I'll know when to sell at the peak. I'll sell. Don't you watch me. I am really good at this. It's around 25+% and people still aren't selling. The retail public is not sold. It tells us this is a long ways to go down. Interesting, yeah? So let's look at the S&P 500 because it doesn't show volume on here on my chart. But from a technical standpoint, we now are breaking down below the December 2018 highs, which we knew were driven by corporate share buybacks, which are pretty much going to be gone completely if they're not already gone. And who's buying between here, 2,400 and 2,100, there's not a lot of support. So it tells me we're headed down to 2,100. And I've said before, when the market gets down to 2,100, I believe you'll see the boomer sell. And it's not until the boomer sell that the market bottoms, puts us somewhere with some debate. Let's go back out a little bit. Perhaps around this 50, some people are saying 1,700. I'm thinking maybe 1,500 could be the number, but I think we could get lower than where we were back in 2016. I think we go down into here somewhere. Why there? Because that gets you back to the peak of the prior two bull markets, say around 1,500 and change. But remember, the markets do not bottom. Very key understanding here. Markets do not bottom until retail sells. And they're not selling. And they're going to, because if you think the economy is going to magically turn around tomorrow, look, even if the coronavirus wasn't in the US, people aren't going to Europe right now. They're not going to Asia. They're not buying stuff from over there. You shut down part of the global economy because we're so integrated, the whole thing grinds to a halt. All right. Oh, I've been asked by two people, when are you going to cover gold again? I've actually been meaning to cover gold for months, but we'll probably do that in another update because, well, that's just the plan. Let's go back now to, that's not it, and see how hedge fund managers are positioned. Because he uses opportunity and knocking. I was impressed. And remember I said I thought last week that hedge funds were back shorting the bond market on the dip. There you go. They're not even, Treasury bonds will not peak until hedge funds are net long. They increase their short positions. They're getting crushed. And on the 30-year, they increase their short positions. This is not the time to sell your bonds. There's money to be made in this play still. And the Fed is going to squeeze them out. Do you kind of understand what's going to happen here? And why the market, in fact, this may be the most important thing I share with you in this entire video, is why is it that cutting rates causes markets to barf and blow up all over themselves? It's really simple. It's not cutting rate, the notion that lower rates are good, right? We know that in a debt-based economy, you need lower rates to create lending demand. It's nothing to do with that. In fact, I would bet if the Fed came out and said, we're going to make a 0.25% cut every 6 months from here until we get to zero, we wouldn't have a major problem. The faster the Fed cuts, the worse it gets. The market becomes very illiquid. Why is that? It's the American thing in investing is you buy stocks and short the bond market. Now, if you don't directly short the bond market by not owning them, you're short the bond market. But that is the deal. You believe inflation is coming to America no matter what. So what happens is you get everybody lopsided on this one side. They're over in stock world. And they're short bonds, so one directly or indirectly. And the Fed starts buying bonds. And what it does is it starts to squeeze the short seller. Now, by the time the Fed gets around to doing this, it's always too late. And so those people who are short the bond market suddenly have to sell their stocks to buy bonds. Somehow they have to cover their shorts. But by this point in the game, they're also short volatility. So they're all mispositioned. And the biggest player in the entire world who has the deepest pockets to buy an unlimited amount of US Treasury securities and mortgage-backed securities effectively runs the biggest short squeeze. They're like the biggest hedge fund in the world, shorting the entire market out. Bet no one's ever told you this is how it works. It's exactly how it works and why it happens. So the Fed is shorting everyone out. People say oil can't go to $20 a barrel or less. Well, it can when you look at how many people are long oil. There's a lot of long oil contracts with oil sitting under 30 a barrel now. Crazy. Hedge funds are still long S&P. And remember, they can get deeply short this market, drive it down. There's more to go. How about gold? And people are like, well, when are you going to buy gold? When all these speculators get wiped out? How low do you think it could go? I'm feeling somewhere between this 1,100 and 1,200 level. That's my opinion right at the moment. Ask me when I sell my bond positions, I'll give you a better idea. They're long the NASDAQ. I mean, we've seen the hedge funds can get deeply short the NASDAQ too. They can get deeply short small caps, and they're not. And they're long the dollar, which should be going up, and it is. But look at even volatility. There still is last Tuesday, it's still net short. Let's continue on with this world dollar liquidity thing. I know I'm jumping around a little bit. But look, when world dollar liquidity goes up on a year-over-year basis, which is going to when the Fed turns on the blower here, I mean, they're going to do, you think 700 or 800 billion of QE is a lot? You ain't seen nothing yet. And look what happens. Yields crash right there. You see it, boom. Why is that? That is the world's biggest short squeeze. And you see it right in here too. You see the red go down. Why? The Fed is shorting out people. You see it up here. Look, boom, Fed short. The Fed's going to short, effectively squeeze the shorts out, drive interest rates to zero, and then I'll look smart. How about volatility? This is the evidence. The VIX is now actually over 80 as of today, which is ridiculous because it's higher than it's ever been. It's higher than the great financial crisis, and we're still not at bottom, telling us that there could be a major flushing of stock prices. And the VIX is just giving us an inclination of how much QE the Fed's got to do, and they've got to do way more than they think. So volatility is going to go up because of the Fed. This is all at the hands of the Fed, my friends. The Fed is creating the biggest short squeeze in the market, and they're doing it at the fastest rate they've ever done it. They're going to blow up stocks, and it's going to happen. It's pretty crazy to think, but this is exactly what's going on. Let's take a look at a few charts. We looked at the S&P 500. Everybody thinks rate cuts are great for stocks. There you go. You got 4 rate cuts right here, and stocks broke technical support. I think we've got a quick date down to 2100 coming up next, and then that's when you start seeing the selling before this thing comes grinding to a halt. Treasury yields, again, went down, bounced up. Let me zoom in. And I said this was creating a bearish wedge or flag, and sure enough, the Fed is buying today. They are bought on Friday, and they're buying down the federal funds rate. Which you say, what do you mean by buying down the federal funds rate? Well, look, it's not like there's a switch on the wall. They go, oh, we're at click, 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 or type it in a computer. They have to actually buy T-bills. So every quarter point is worth 60 to 70 billion in T-bills. So that means they just dropped it 4 times. That's 240 to 280 billion of T-bills they got to buy probably over the next several days. Then they bought a broad range of 40 billion of stuff today. Yields are going down. The biggest buyer is buying them. I mean, I told you this. Why the big banks are buying it. They're going to make a profit off the Fed. The Fed doesn't care. Let's take a look at TLT. Remember, I said here's this big flag, broke higher, and it's headed up. This is going to make new all-time highs along with zeros, along with IEF, along with everything else. Treasury yields are going to zero. There's no demand in the economy. The longer the coronavirus hangs around, the worse it gets. And we heard from President Trump today that they think we may not get out of this until June or July. That means the U.S. economy is going to get worse. The European economy is going to get worse. We're already seeing numbers, and we know these aren't even the worst yet, that are worse than the great financial crisis. But get ready. When volatility explodes, yields will crash to zero, and then the fun really begins. When everyone sells, that's the time to buy. I'll be back with you on Wednesday. I'm sure we'll have some very interesting things to talk about then, and we'll see what the markets bring us. Until that time, remember, if you think this market's bouncing back, I'll leave you with this parting thought. Let me bring the slide back up. Remember, the biggest buyer over the last 10 years was foreigners who probably are selling because they're under quarantine, and corporates who are probably not buying any stock because now they're turning to look to the government for a bailout. If you think they're going to come back as soon as it's over, forget it. They're probably the reason stocks are indeed falling. So with that, I'm Steve Van Metre. Thanks for taking the time to watch. We'll see you on Wednesday. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. Materials not to be construed as recommendation or solicitation of buyer selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed in the video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.